Welcome to Dreamit Dose. I'm Steve Barsh, and today we have a special guest, Daniel Zimmermann from Wilmer, Hale in Palo Alto, California. Daniel is going to be talking about the 5 biggest mistakes founders make when they're signing term sheets. Let's dive in.
Dreamit Ventures has been investing in great early-stage startups for over a decade. The Dreamit Dose allows us to share best practices to help even more founders. Tell us about your great startup using the links below.
Thanks, Steve, for having me on Dreamit Dose. Very happy to be here and talk to you today. Again, I'm Daniel Zimmermann. I'm the chair of the emerging companies practice of Wilmer Hale here in Silicon Valley. And I've worked with over 1,000 companies over the last 22 years and have looked certainly at least as many term sheets over these years.
So Daniel, having looked at and worked on over 1,000 term sheets, would you say that probably one of the biggest mistakes is that startups and founders really don't even understand the terms being used?
Absolutely. I think, Steve, you hit it on the head there. Ultimately, really, the first thing is to actually read the term sheet. It sounds as simple as that, but frankly, often founders send it to us. They're super happy about seeing a certain number on the term sheet, mostly focusing on the valuation. And that's almost it. And then they say, can you just tell me that this is all good and we can sign it? And so what we're seeing here is that valuation becomes before investor fit. Sometimes founders come to us and say, we really didn't like the investors that much, but the valuation is awesome. And of course, ultimately also, they don't look at other terms. Like, our for example, the founder share is going to be revested. Are you starting from scratch from a vesting perspective? What is being proposed around board control? All these things are very important. And in particular, when it gets to operational matters, what kind of protective provisions, what kind of veto rights do these investors have? And it's all sort of part and parcel of those terms. But and it's hard to untangle sometimes. And that is what I believe is really important for an entrepreneur to understand, is that there's a lot of expertise. These have been built over the last decades, and these term sheets. There's a lot packed in there, and you really have to understand what you're getting.
Could I ask, Daniel, when we say that sometimes founders have some significant misunderstandings of what the terms mean, what are the 2 or 3 biggest terms that you find founders really don't understand what that terminology means one way or the other? What are the 2 or 3 biggest things maybe you see them trip up on?
Well, some of the things, what I think is really important to understand is pre-money and post-money valuation concepts. So what we're seeing often is the terminology around proposed post-money valuation if a certain raise occurs. And as you know, there's often ranges of let's say like a $3.5 to $5 million raise. What does a post-money valuation mean in that context? And how does, for example, an option pool play into that? Is it unallocated? Is it allocated? What does that really mean? And ultimately, of course, what plays also into this is what current convertible securities do you have outstanding? Do you have safes outstanding that convert on a cap? Do you have safes outstanding that convert on a discount? Do you have convertible notes? Well, the same with caps or discounts. All of those things really matter very much. And what's important to really understand what you're having out there so that you can understand the post-money valuation, if it's a post-money valuation, or pre-money valuation for that matter, if that's proposed. It's going to matter a lot to understand what that term means.
Right. And I think all the points you're pointing out are great. Even one that you were just mentioning right now about caps and safes. We hear a lot of entrepreneurs, well, I'm doing the $8 million round with a 20% discount. And they think it's an and. It's an 8 million cap and 20%. It's like, no, it's an or. It depends on which gives the investor the better deal. So there's such subtle changes in the meaning based on the terms being used. So I think it's really good. Like you had said, first big mistake seems to be they don't understand the basics of the terms, and it is a term sheet. So really important to get that vocabulary out of the way, or work with a great attorney who can help you get that vocabulary out of the way.
Well, Steve, I think you're right. I mean, ultimately, it's all about understanding what you're getting into, right? I mean, ultimately, when you're signing a term sheet, let's just be clear, it's usually non-binding. So what you're signing is often just a confidentiality clause and no shop clause. You can't shop the term sheets, meaning confident from a confidentiality perspective, and usually also a time period where you have exclusivity. So those are usually the only terms that are actually binding if you sign a term sheet. And sometimes, by the way, some folks actually never even sign term sheets. They just send them around and work on that basis. But that's another thing. Ultimately, there is still a codex of, if you will, a gentleman's or gentlewoman's agreement, a handshake agreement where you say these terms are going to be used in the definitive agreements. And if you may have a bite or two to change some of the terms once you understand them, but it's really hard for you to go back 3 or 4 times and say, oh, I didn't understand that. And now that I talked to my attorney, I didn't realize it. Actually, first of all, it shows that, maybe not up to the task and you haven't done your homework. That's a problem.
That was great. In that last section, you were talking about valuation and sometimes how founders focus on valuation. I think that leads us into mistake number 2. We see this all the time at Dreamit Ventures as well. In the last week alone, I've gotten 2 emails from Dreamit founders who say, we just got a term sheet and they tell me what the valuation is and tell me nothing else. Daniel, what do you see as some of the mistakes that founders make on focusing only on valuation?
Yeah, Steve, I mean, that's exactly the point that we try to make every single time when we talk to founders, is that valuation is definitely, important. Economics are important, but economics are not determinative only by valuation. It also means what you also want to look at, for example, is what kind of anti-dilution provisions do you have? For example, sometimes an investor says, you know what, I'll give you this crazy valuation that you're looking for, but ultimately I'm going to put a full ratchet anti-dilution protection in there. So what that means for a fact is that if you ever raise money at a lower valuation, your valuation ratchets down to that later valuation. That's just one example. If focusing valuation is stupid if you don't look at the anti-dilution provision, for sure. It's completely tied to that. The second one clearly is an investor could say, well, I'll give you a great valuation, but you know what? I'm going to block every single future financing. I have the right to block every single future financing. Well, that may be okay with a blue chip investor, because what are they going to do? They're always going to try to continue to have good investments come in, and they will also allow a new lead to come in. But that's a big one. You have to understand, if you're dealing with a quirky investor, particularly, let's say, a high net worth individual who has never done venture before, that could be a problem, because they could just freeze you out, never raise more funding because they've got a block.
It's interesting, by the way, in one of the first companies I was running, I remember talking to a very high net worth individual. You were mentioning about pulling the plug, and I'll never forget. He's like, Steve, these are the terms I want. And if I don't get them, I'm willing to pull the plug. And the great thing is, I'm bigger than the drain. So I don't really care. I'll never forget that. I'm bigger than the drain. I was like, that got etched in my memory permanently. Daniel, earlier on, you mentioned about stock option pools. And it seems that that's really mistake number 3, is that founders really don't understand what's going on. Could you talk to us about that?
Yeah, sure, Steve. The one of the issues that we're seeing often is that ultimately a lot of founders don't really model out properly the relative dilution they will be taking in a financing, especially when the stock option pool and the size of it and the unallocated stock option pool in particular is at stake. And so, and it's not sneaky, it's just part of the term sheet negotiation. The VCs will typically sneak in, I could use that, a term that is like, we will want to have a 10%, let me just say 10 or 15%, sometimes a 10% unallocated stock option pool on a post-money basis. What does that mean? It ultimately means, of course, that when all is settled and all is done and dusted, at that particular point in time, after the financing has come in, there is a 10% option pool that is unallocated. So it's not been given to anyone else, not promised or anything like that. And that's important, because ultimately when you look at, as an example, a $10 million pre-money term sheet, and you have, for example, it's also quite typical, a $2 million in convertible notes or in safes outstanding with a cap, the impact can be drastic. Essentially, depending on how much money you're going to raise, but let's just say, in this new round, you were to raise $2 million on a $10 million pre, you thought, oh, I have a $12 million post-money valuation. Well, again, but you didn't read the fine print. You didn't read that, first of all your safes are converting on a post-money basis. And on top of that, your option pool is going to be 10% unallocated on a post-money basis. So, depending on what the discounts are, you run into a really massive dilution. And in particular, the higher, of course, the discount or the cap, or the lower the cap of that safe is, the more you will see that impact.
Yeah. So Daniel, the other big mistake within that big mistake of number 3 around the stock option pool isn't just the unallocated portion of the stock option pool, but the founding team themselves and what can happen.
Yeah, absolutely. It's very common, especially if, for example, it took a little longer to get to the first financing, that the VCs will say, well, we need to have you to have skin in the game. You have to have skin in the game. We want you to be there for another 4 years. We believe it's really necessary. You've only just now, make an example here, only just now found product market fit, yada, yada, yada. So, we really can't give you any credit for the things that you've done before. And literally in the term sheet will be one sentence that says the vesting terms will be reset to the initial round of funding, the date of the initial round of funding. Very important. That's the very first thing I look at, because that has a huge impact potentially. Because if you think about it, if you have absolutely no upfront vesting as a founder, you're really in a very precarious situation, especially if you were to lose board control. Right? If you were to lose board control, you really could get fired and not get the benefit of the vesting that you should have already gotten. I mean, maybe one other thing on that is, of course, there are sometimes absurd consequences, right? And I've had that in the past where, let's say you have 3 founders, all of which have started vesting. One of them does an early exit after 6 months, and you say, you know what, we'll give you the 6 months upfront vesting, the vesting that you earned, and that person at that point walks away. Let's, for example, with 12.5% of the company, or like something like that. Then you get to the financing. Then you get to a reset of the vesting for everyone else. So the people who are there get punished because the VCs come in and say, well, look, you've already given away, there's so much debt equity, we got to reset, and you guys have to start all over again. I mean, these are all real life examples, and you need to understand what you're getting into. Maybe it's the right thing. Maybe you actually agree to that, but don't walk in there without understanding those terms, because renegotiating that after their investment committee has approved it, once you've signed the term sheet or agreed to a term sheet, it's very difficult.
So when you're dealing with term sheets, what about IP?
Steve, very good question, because often you look at a term sheet and it may not even have a provision around IP, but there are many term sheets that very specifically call out that the IP has all been assigned by the founders to the company. But even if it's not in there, you have to imagine that every VC thinks that all the IP is wrapped up in the company. There's nothing going on. There's no holdbacks. There are no licenses, out licenses, in licenses that are still required. For example, you still haven't negotiated your license agreement with the University of Michigan or University of California or what have you. Those are things that you would be very hard-pressed to bring up only in the diligence. Those are things that really need to be brought up almost at the term sheet stage, because they impact the valuation potentially, but not just that, also, their view on what have you done so far. But it's a really good question, because it goes then potentially to some terms, right? The terms could be as stringent as what we call founder representations around IP. By the way, not entirely uncommon, where if you're early on, the investors want to say, I don't want to get just some representations from the company, that the company, which is sort of this thing, this construct, that the IP is owned by the company. No, I want it from you personally, you founders. And that means potentially your, a little house or a little condo is on the market. I mean, I'm exaggerating, but it is. You are on the hook personally. And founder representations, personal representations, we fight for, until the cows come home, we do not want to give founder representations. But we also have to be prepared if we don't have our house in order. So very good question, Steve. I mean, if you don't have your IP house in order, you're going to get some terms that are potentially not very favorable to you as founders.
So it seems one other big mistake when you're negotiating term sheets is you have people working on your side that really have a lot of experience.
Yeah, no, I mean, look, what I think is really important is that you work with people who have done this before. Again, just like the VCs. So it could be a fellow entrepreneur. Sometimes, you'll find some entrepreneurs who are incredibly savvy around business, these terms. And they have done it before and they've done very well. Caveat there is, of course, that not everyone gets the same terms, right? So it does depend a little bit on who you're working with, et cetera. And I think what's also important is what the terms are that VC in particular proposes. Now, and here I think attorneys come in that do this type of work a lot, like myself, but many others here in Silicon Valley and other places, tech centers around the country. You have people who focus on emerging companies, and emerging companies and ECVC, we call them emerging companies and venture capital lawyers. They do nothing but work on these types of transactions. And why does it help you? Well, it helps you put it in perspective. We see so many term sheets that we kind of runs the gamut from super light one pagers to 15 pages of provisions, even with ESG, covenants and stuff like that. So you really need to work, I believe, with someone who has done this before. And this is not going to be your free resource who is, your brother-in-law's neighbor who is a wills and trusts attorney. It's not the same thing. Being a lawyer, just like a doctor at this point, you have very specialized. Same thing here. And you really should work with someone who has done it before. But again, other research, you have other advisors. Sometimes in accelerators, you have amazing advisors who have a lot of knowledge around terms. And of course, your network of people who have done it before. Just work with someone who has done that and don't let other people screw your deal up.
That was great, Daniel. Let's just do a quick recap. Number one, make sure you understand what the terms mean. For goodness sakes, it is called a term sheet. Number two, remember, valuation doesn't live in a vacuum. Be really careful because there will be strings attached. Number three, stock options. Make sure you understand how the stock option pool works in the term sheet, what's going on with founder vesting. Number four, your IP. You're going to be signing reps and warranties. Make sure the IP is in the company. Things are clearly defined in the term sheet, and be careful if you're going to be signing for it personally. And number five, make sure you're not outgunned. Make sure that you have people around you that also have experience in negotiating term sheets so you get a fair deal. And that's your special Dreamit Dose on term sheets. Thanks for watching. If you have questions, please leave them in the comments. Also, please make sure to like and subscribe. We have a lot more coming.